What would you do if you paid your entire tax bill by April 15th and the IRS penalized you anyway? It happens to millions of filers because the underpayment penalty is based on what you owed each quarter, not what you owe at filing. That single misunderstanding is quietly draining money from people who did everything they thought was right. I read the fine print, so you don't have to. There are two quiet IRS penalties hiding behind that April deadline: the underpayment penalty and the accuracy-related penalty. And together, they hit millions of taxpayers who genuinely thought they were square with the IRS. Today, I'll walk you through 3 moves. Check your withholding, review your return against every form, and estimate whether you owe quarterly. Here's the number that reframes all of this. The IRS projected $542 billion of underreported tax for tax year 2021, IRS 2023 tax gap projections. But here's the part nobody tells you. That's not late payment. That's income never reported correctly in the first place. The single biggest leak in the entire federal tax system. 3 moves, and each one takes under 20 minutes and costs nothing. Check your withholding against the safe harbor, review your 1040 against every income form, and estimate whether you actually need quarterly payments. Here's the mechanism most people miss. The underpayment penalty isn't about your final bill. It's about whether you paid enough during the year, quarter by quarter. IRS. The IRS gives you a safe harbor. Pay at least 90% of this year's tax, or 100% of last year's, or owe under $1,000 after withholding. And you're protected. Now here's the trap for higher earners. If your prior year adjusted gross income topped $150,000, or $75,000 if married filing separately, that 100% safe harbor jumps to 110% of last year's tax, IRS. So one extra 10% of last year's tax is often the entire difference between safe and penalized. The second layer is nastier. It's the accuracy-related penalty, and it applies when you substantially understate your tax, meaning you understate by 10% of the tax you should have shown, or $5,000, whichever is greater, IRS. Underreport income, and you don't just owe the tax later. You owe a penalty stacked on top of it. So there are 2 completely separate ways to get hit. Pay too little during the year and miss the safe harbor, and you owe an underpayment penalty plus IRS interest even if you clear the balance by April 15th. Or underreport your dividends or side income past that $5,000 line, and the IRS adds a 20% accuracy penalty on the underpaid tax, IRS. The myth that costs people the most is simple. Pay your bill by April 15th, and you can't be penalized for the year. The fact is, the penalty is based on each quarter, not filing day. So missing your required quarterly payments triggers it even with a fully paid balance, IRS. Put the 2 numbers side by side, and the scale is stark. $68 billion was reported on time but not paid on time, while $542 billion was underreported entirely. Both for tax year 2021, IRS 2023 tax gap projections. Underreporting is the far bigger leak, and it's exactly the gap the IRS targets. Meet Evan. He's 41, a salaried project manager in Texas earning $135,000, married filing jointly. He's got about $18,000 in a brokerage account throwing off dividends and gains, and he's roughly 24 years from retirement. Here's what Evan found when he actually read the rules. His first discovery hit the safe harbor head on. If his withholding and estimated payments don't cover at least 90% of this year's tax, or 100% of last year's, he can still owe an underpayment penalty, even though he can easily write the IRS a check in April, IRS. Paying in full was never the same as paying on time. His second discovery was the accuracy penalty. Because it's 20% of the underpayment tied to a substantial understatement, that $5,000 threshold matters as much as the percentage test, IRS. A single overlooked chunk of brokerage income could flip him from a small correction into a penalized understatement. His third discovery was the most unsettling. The IRS projected $542 billion of underreporting for tax year 2021. showing this is a system-wide problem, not late payment, IRS 2023 projections. And his small side income omissions. Those are exactly the kind of gap the IRS is built to catch. Let's model Evan's exposure. If his total tax is $24,000 and he misses the safe harbor by $4,000, the estimated tax penalty applies to that shortfall, roughly $800. And if the same mistake creates a substantial understatement, the 20% accuracy penalty adds another $800. IRS. That's around $1,600 before interest, an author's estimate using IRS thresholds. So could this be you? You've never checked your withholding against the safe harbor, you don't actually know whether all your dividends and side income were reported, or you haven't made a single quarterly estimated payment this year. If any of those ring true, the next 3 moves are exactly what you need. These 3 moves matter because each one closes a different door the IRS can walk through. One guards against the underpayment penalty, one against the accuracy penalty, and one against getting blindsided by a quarterly requirement you didn't know applied. Do all 3 and you turn a surprise penalty into a boring, predictable tax bill. Let's take them one at a time. Move 1 is to check your withholding. Open the IRS withholding estimator and enter your wages, your side income, and how much has been withheld so far. Read the projected year-end balance, then compare it against the safe harbor. 90% of this year's tax, 100% of last year's, or 110% if your prior year AGI topped $150,000, IRS. 3 quick steps. Enter your wages, side income, and withholding to date. Read the projected year-end balance the tool gives you. Then compare it against the 90, 100, or 110% test. Good looks like a projected balance under $1,000 or one of those percentage tests clearly met. Move 2 is to review your 1040 against every form. Pull your IRS account transcript and gather every W-2, 1099 INT, 1099 DIV, and 1099 NEC you received. Match each income line on your return to its source document and flag anything missing that could push you past the 10% or $5,000 substantial understatement threshold, IRS. 3 steps here too. Gather every income form and your prior return, match each line on the return to a document, and flag any gap that creeps toward that 10% or $5,000 line. Good looks like every income item tying cleanly to a form, with no unexplained gaps. Before I get to the last move, which is the most counterintuitive part of all this, remember that the first 2 moves only protect you if you know whether you owe quarterly at all. Move 3 is to estimate exactly that. Take your total expected tax, subtract expected withholding and refundable credits, and if what's left tops $1,000, you likely need estimated payments to stay inside the safe harbor, IRS. Start from your prior year return, and this year's income changes. Subtract expected withholding and refundable credits. And if the result is over $1,000, set quarterly payments that meet the safe harbor. Good looks like a balance under $1,000, or 4 payments scheduled. If breakdowns like this are useful, subscribe. The next one's already coming. Here's why this is urgent right now. In 2023, the IRS confirmed prior year AGI above $150,000 requires the 110% safe harbor, not 100 IRS. That same year, it published tax gap projections of $542 billion in underreporting and $68 billion in underpayment for 2020 and 2021. And it continues to assess penalties on missed installment timing every quarter, IRS. Once you've acted, verify it. You should see a projected balance under $1,000 in the estimator. Confirm that every income form has a matching line on your 1040. And if your tax due tops $1,000, make sure 4 estimated payments are actually scheduled. Everything here comes straight from IRS guidance on the underpayment and accuracy penalties, plus their published tax gap projections. All the links are in the description below, so you can check the exact thresholds yourself before you file. You now know why paying by April 15 doesn't stop the penalty, and the 3 moves that actually do. Next, I'm covering how the 4 estimated tax deadlines quietly reset your penalty clock 4 times a year, and where most people get caught. That quarterly deadline breakdown is the one most filers wish they'd seen a year earlier, because it changes when you pay, not just how much. If you want to catch that, subscribe now so you don't miss it.